All right, let's dig deeper into this and the state of the U.S. economy and markets around the world with Rosenberg Research founder and president David Rosenberg. David, I know you've been listening to our conversation intently and with interest, and I'm wondering how you assess sort of the exposure the economy could have if this is, in fact, the next so-called shoe to drop.
Right. Well, look, we saw shoes dropping last year, with Silicon Valley Bank and some others. Of course, that was more being upside down on their treasury securities, and it created a ripple. But, the Fed and the authorities intervened and prevented it from becoming a crisis. What's interesting is that a couple of months ago, after one of the FOMC meetings at the podium, Powell, when asked, actually said that he expects that there's going to be regional bank failures this year. So he knows that this game is not over. The question is, how can they smooth the transition, when these regional banks start to fail? And of course, we'll see more consolidation, so on and so forth.
Hey, David, it's Dan. Thanks for joining us. You've been on the lower inflation train for a very long time here. And I'm just curious where you think you see inflation in the U.S. bottoming out a little bit. And what do you think some of the ramifications might be for that? Because obviously some of the data that we've seen of late has been a bit firmer, and inflation expectations haven't come down that much from this 3.1% in the CPI.
Well, the market-based inflation expectations have been basically stable for 3 years. I mean, I think the 5-year and 10-year tips break-evens have been stuck around 2.3%. That's nothing to be concerned about. But, when you talk about U.S. inflation, I mean, firstly, it's a lagging indicator. I'm very concerned that the Fed is busy chasing lagging and contemporaneous indicators. And what's holding up the U.S. inflation rate, over and beyond the fact that we had this bump up in insurance rates, whether it was autos or whether it was home or health insurance this year, which is nothing the Fed can really control, what's been holding it up for the most part is owner's equivalent rent. And, what's interesting is that when you look at the U.S. inflation numbers and you put it consistently with how they do it in Europe, because Europe does not have OER, the underlying inflation rate in the United States is 1.9%. And yet nobody talks about it, I guess, except for me. Certainly the Fed doesn't. So a lot of it's going to depend, and Powell talked about this, is how painstakingly slow it's been for the rental numbers, especially OER, which is 27% of the index, to start to soften up. But that's really, your inflation story for this year has been insurance, and it's been the rental numbers. Outside of that, there was no inflation in the data.
Hey, David, it's Courtney here, and thanks for joining. When it comes to the commercial banking space here, you saw the Fed was actually willing to come out and they were bailing out the regional banks. And I think that somewhat did put a floor on the issue that we're seeing in the commercial space right now. And so my question to you is, how much does that going forward create a floor there? Are people not worried about what's happening in the real estate market because the Fed is willing to step in?
Well, look, regional banks did fail last year. They didn't prevent that. What they prevented was a contagion. And that's what they will do again. How they end up doing it, your guess is as good as mine. Do we create a bad bank, an RTC-like situation like we had with the commercial real estate debacle of the late 1980s? The concern for, the central bank is not so much about banks failing. The concern would be, does it, engineer systemic risk through the financial system? And that's really what they're going to be focused on.
Are you not worried because you think the Fed is going to step in?
Well, I wouldn't exactly be an investor in regional banks, and I do have a more defensive bent towards the stock market, so it really depends on how you're positioned. No, I'm not concerned this is going to turn into an unmitigated disaster. We all know the story, and we know that it's going to be a suppressant on growth. The conversation before about interest rates, it's not about interest rates staying stable. If we're going to actually prevent this from becoming something worse, the Fed is ultimately going to have to cut rates. They'll wait, I guess, for inflation to come down more quickly than it has. But we're not talking about just interest rates stabilizing. You're taking a look in the broad business sector, where these loans were originated were between 200 and 300 basis points above the level of rates right now. Rates are going to have to come down a lot to stave this off, alongside some of the other more direct measures that the Fed and the Treasury are going to have to make.